Is the sleeping giant stumbling? As the world watches, questions emerge about the stability of China, a nation that has long been a symbol of relentless growth and economic might. China, as of recent data, holds a significant amount of US dollars in its foreign exchange reserves, surpassing even the United States. This situation may seem surprising given that the US is the issuer of the dollar currency. Based on its massive foreign currency reserves, China has been directly investing in infrastructure projects around the world, in Europe, Asia, Africa, and reaping economic benefits through its Belt and Road Initiative, thereby extending its influence globally. Despite the appearance of unstoppable growth, the Chinese economy is often described as being in a precarious situation, potentially on the brink of collapse. Furthermore, reports suggest that future prospects are increasingly dire. So, what's the underlying issue? While other factors contribute, China's precarious economic path is fundamentally paved with debt. Surprisingly, China is known for having low national debt, at least according to reports from the central government. It's reported that China's national debt is about 77% of its GDP. This figure, indicating the proportion of debt to income, does not seem too high, especially when compared to the United States, where the debt-to-GDP ratio is 122%. However, this low debt figure for China only includes debts incurred by the central government. In China, not only the central government, but also local governments, state-owned enterprises, and even individuals take out lots of loans. The 77% debt ratio does not include the debts of local governments, state-owned enterprises, or individuals. The debt of China's local governments is said to be enormous, to the point of being incalculable. Often, local governments underreport or fail to report their debt levels, making accurate estimation difficult. Goldman Sachs, drawing on various data sources, estimates that the debt of Chinese local governments exceeds $23 trillion, amounting to more than 130% of China's GDP. When combining the central government's debt, which is 77% of GDP, with that of the local governments, the total debt of China exceeds 200% of its GDP. This calculation does not even include the debts of individuals. Experts attribute this excessive spending by local governments primarily to overzealous infrastructure investment. With China's rapid economic growth, local governments have been competing to urbanize their regions, building residential areas, commercial zones, and industrial parks. However, most of these infrastructure investments were financed through bank loans or bond issuances, leading to a new debt crisis. Chinese state-owned companies and individuals have also been heavily investing in urban development. Construction of buildings and infrastructure, such as residential, commercial, and industrial facilities, is primarily carried out by companies like China Construction Engineering Corporation and China Railway Corporation. These state-owned enterprises have also been investing heavily in infrastructure, often funded by debt. The debt of Chinese state-owned enterprises alone amounts to approximately $15.6 trillion, around 90% of China's GDP. Including all known data, China's debt-to-GDP ratio reaches 300%. Local governments and state-owned enterprises have borrowed extensively for infrastructure development, creating homes and improving transportation infrastructure. The final consumers, the Chinese people, are attracted to the newly built apartments and sophisticated infrastructures. Many end up taking out substantial bank mortgages to afford these properties. The exact amount of consumer debt is difficult to estimate, but according to a Hong Kong-based media outlet, China's current consumer debt is about 60% of its GDP. Combining the debts of the central and local governments, state-owned enterprises, and consumer debt, China's total debt reaches about 360% of its GDP. However, a country's debt being several times higher than its income is not necessarily a problem if future income increases. If a country can increase its earnings and gradually pay off its debts, there should be no issue. But China currently faces difficulties in this regard, primarily due to its sharply declining economic growth rate. While China once experienced double-digit economic growth, it has recently dropped to around 5%. Although a 5% growth rate is not inherently low, especially considering that advanced economies like the US and Europe aim for an annual growth of 2 to 3%. China's situation is worrisome because all its investments and debts were predicated on higher growth rates. If a person expects a 10% annual salary increase and plans expenditures accordingly, a sudden drop to a 5% increase would lead to overspending. Similarly, China's current economic situation is analogous, with lower growth leading to various negative effects, including the emergence of ghost cities, cities with many buildings but few residents. These were built expecting a population influx due to rapid economic growth, but the market conditions changed drastically. China's current economic challenges are further complicated by deflation. Unlike inflation, where prices increase, deflation involves a decrease in prices. As Chinese consumers cut back on spending, businesses lower prices to boost sales. Lower prices might seem beneficial for consumers, but the real issue with deflation is the decrease in corporate profits. If companies earn less, they cannot raise wages and might even reduce them. This leads employees to spend less, creating a vicious cycle potentially leading to corporate bankruptcies and job losses, which would severely damage the national economy. In summary, China faces significant economic challenges, including debt, slowing growth, and deflation. While the path of the Chinese economy is not entirely bleak, the global community is closely monitoring its situation. It remains to be seen how China will navigate these economic challenges. And that's all for today. Thank you for watching.